So how to profit from a stock without caring where it goes, if it goes up, if it goes down, if it moves sideways. So let me show you a few trades I made on Tesla to explain how you can be profitable on a stock without really caring where the stock goes. So first of all, March 18, I sold an iron condor on Tesla. So an iron condor is a option selling strategy where you don't buy the stock at all. All you do is sell a put option and sell a call option, but at the same time you buy a put option and a call option for protection. So the way it is set up, for example, on March 18, when I sold that iron condor on Tesla, I believe it was trading at around 260 or 270. I gave myself a range that I think Tesla will be trading in between the day of purchase, between the day I placed the trade and the expiration of the options. So that range for me was between 235 and 320. So when Tesla was trading at around 260 or 270, I felt confident that by expiration date, which was April 18, Tesla would not be trading below 235 and would not be trading above 320. So since this is an option selling strategy, by selling the 320 call and selling the 235 put, but then buying the 230 put and buying the 325 call, I was able to collect $140. That's with one contract. My maximum loss, my maximum risk on this trade is the difference between the spreads and premium that I already collected. So the difference between the spread is either the put spread or the call spread is $5. So $5 minus $1.40 of premium collected is $3.60 times 100 because it's one contract, so that's $360. So I collected $140 up front, and worst case scenario, I would lose $360. Because worst case scenario, if the stock is trading outside of the range of this trade, so below 230 and or above 325, for me to close this trade, I would have to pay $500. So I already collected 140, so my loss is $360. But of course, the probability of that happening was much lower than the probability of Tesla staying within the range of 235 and 320. So because it has a high chance of success, I placed this trade. Now, on April 9th, so about 2 or 3 weeks later, Tesla started going down. So I'm getting close to expiry date, but still, I can still be worried. So I felt like it would be a good time to close the trade, to get out of this trade. And I was able to close the trade, so buy back the option spread that I sold. So I opened this trade by selling, and I'm going to close it by buying. So I closed this trade by buying back this iron condor at $23. So I sold it for $140 and I bought it back to close it for $23. So my profit is the difference of $140 and $23. So about $117 profit in a matter of 2 or 3 weeks. So what's even better about this trade is the rate of return. So it's $117 on a risk of $360. Because going into this trade, my risk or my investment, my max loss was $360. Out of that investment of $360, I made a profit of $117. So that return is pretty high. And that's just in a matter of 2 or 3 weeks. And I didn't have to care where Tesla was going. I didn't have to predict if it's going up or if it's going down. All I just had to worry about is that it stays within a certain range. And I didn't have to have enough money to buy shares of Tesla or 100 shares of Tesla either. I just want Tesla to stay within a certain range and I make my profit. And then on April 15, as you could see, I placed another iron condor expiring May 17, so about 30 days out. This time I collected $100, but this time my range was between 215 and 330. And once again, I think Tesla was trading at around $260. So I went further out to give myself more chance of success. So as long as Tesla stays above 215 by expiry date of May 17 and stays below 330 by expiry date of May 17, then I make my max profit of $1 or $100. But once again, when I had the chance to close this trade, I decided to buy it back because you never know what could happen. I mean, Tesla this week was trading in the 230, so it was getting close to my put side of 215. And Tesla is a stock that can move easily 10 or 15 points in one day. And I still had 2 weeks left. So when I felt like I had the chance to close it at a decent profit. So I sold it for $100. I was able to buy it back for $25. So I made a $75 profit in also a matter of 2 or 3 weeks. So I risked $400 to make a profit of $75. So once again, the return is pretty high. The rate of return is pretty high. And it's just in a matter of 2 or 3 weeks with a small upfront investment. And I didn't have to care what happened with Tesla. I just needed to stay within a certain range. And I gave myself a very big range just in case, from 215 to 330. And then I also sold another one, April 25th. I sold another Iron Condor expiring May 24th, so 30 days out. But this time my range was between 210 and 305. So Tesla on that day, I don't remember, was trading at a different price, of course. So that's why I took this different range between 210 and 305. So as long as Tesla stays above 210 come May 24th and stays below 305 come May 24th, I make my maximum profit of $85 in this case. So by selling the Iron Condor, I collected $85, and my risk, my maximum loss, is $415. Now this trade is still open. I have a chance to buy it back to close it. I believe last week I could have closed it at around $30 or $35, but I'd rather close it a little bit lower. Since I only collected $85, I'd rather close it at around $20 or less. But I still feel safe because the stock is trading in the 250s, which is almost exactly in the middle of my range. So it's above 210 by about 40 points, and it's below 305 by about 55 points. So these are 3 examples on the same stock on how you can profit from a stock without having to care about the direction, without having to guess where the stock is going. You're basically just picking a range in which the stock might move in a particular period. And you also can use something called delta, which gives you the probability that the stock moves within a certain range. And with this Iron Condor strategy, your maximum loss is always the difference between the strike that you sell and the strike that you buy. And even if you're selling a put and a call, because a stock cannot be in 2 different places at the same time, it's either going to be worst case scenario, it's either going to be above your call price or it's going to be below your put price. So as long as the difference between the option that you buy and sell is the same on your put side and on your call side, then you have one risk of whether the stock goes up past your call strike or whether the stock goes below your put strike. So that's what's great about this strategy, is that it doesn't require much capital up front. You can make a decent return on investment in a matter of weeks. It's got a high probability of success. But one thing I don't like about this is that come expiry date, if you're on the losing side, if in one of those rare cases the stock does end up going past your call strike or past your put strike, you have to make a decision either to manage the position by rolling it out or just accepting the loss. So come expiry date, you either made your profit or made your loss. So the fact that there's a predetermined period on this trade puts your investment at risk. But I suggest watching the video from Options Alpha regarding selling option premiums, how to get the edge when selling options premiums. Explains it very well, talks about probabilities. You're basically acting like the casino. By placing a lot of small trades, you will end up profitable because you always have the edge when you're selling option premiums because you're collecting premiums at a high probability of success. So it's like an insurance company. Insurance companies collect premiums from consumers to protect their house or their cars or whatever, but they know that there's a high probability of success that these consumers are not going to claim. These consumers are not going to make a claim. So these insurance companies don't have to pay out $100,000, $50,000 to these consumers. But what's more likely to happen is that the insurance companies keep collecting these premiums month after month. So it isn't impossible that an insurance company makes a big payment and loses money, but the chances of that happening is much smaller, especially if the volume of people paying premiums is high. The small amount of premiums that is collected by many people surpasses the rare times where they have to make a payment to the consumer. So selling options premiums is the same thing, since you are actually selling an insurance on the stocks. So yeah, just wanted to show you how you can be profitable from a stock without having to care if it goes up, goes down, or moves sideways. So if you have any questions, leave them in the comment section below. Like always, if you're gonna open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. And if you want to get live trades as I place them, you can join my WhatsApp group for $10 a month. Link is provided below. And also, if you're looking for an accountant to do your taxes, don't hesitate to message me. Link will be provided below as well. Thanks for watching.